Now tell me, how many of you are having problem with this concept bond price and bond yield? Only one? Okay. So I'll give you a simple example in relation to, see, what I explained is how the price of bond move. Will not take into the reality, we only need to understand the concept. Okay. Imagine, see, are you clear what you mean by a bond? First, are you clear with the concept called bond? See, bond is nothing but a financial instrument. Bond is a financial instrument which will be having a maturity of more than 1 year. Which will be having a maturity of more than 1 year. And basically bond is a debt instrument. Debt means it's a liability, you have to pay interest for it. Any debt instrument, you have to pay interest for it. So bond is a debt instrument which is having a maturity of more than 1 year, and the interest will be mentioned in the bond itself. What is the interest you will be getting for purchasing that bond will be mentioned in the bond itself. Okay, these are the basic features of a bond. Now try to understand that who purchases the bond and who issues the bond. Basically, any individual or company or the government who require fund, they issue debt instruments like bond, and people who are investors like general public, banks, financial institutions purchase it. Now we are discussing in relation to a particular bond what is called as government securities. Now for the investor, the most important thing about government security is that it is risk free, no risk at all, in the sense that once the time matures, as per which year it is, for how many years this bond is issued, once the time is matured, he will get, that individual or the company will get the money which is mentioned in the bond. Okay. Now what I am trying to do is, what this bond yield is all about is when this bond is sold and brought in the secondary market. Now we will discuss, so before going to the secondary market, we will understand the concept, what is this bond yield is all about. Bond yield is all about. Now suppose you consider yourself, you are buying a bond. You yourself buying a bond. Yes. And discussing this concept, bond yield. Now you are buying a bond which is having a face value. In bond face, there will be an amount will be mentioned which is having a face value of 10,000. So you have purchased a bond which is having a face value of 10,000, means when it get matured you will get. Now for this 10,000, the interest, I told you bond will be having an interest. Yes or no? A bond will be having an interest, and the interest for that bond is 10%. So the bond is having a value of 10,000. Its interest is, annual interest is 10%. So what will happen if you are and suppose that the maturity is 10 year. Maturity is 10 year, interest is 10%, bond value is 10,000. So normally every year you will get interest. So in this case, after a year, how much interest you will get? Is it clear with that? After a year, the person who purchased this bond of 10,000, because the interest is 10%, and I will tell you how it is, just 10,000 into 10%, it is 1,000. So you will get 1,000 rupees as interest after a year, because the interest rate is, annual interest rate is 10%. If it is 9%, you will get 900 rupees. So leave that. Now here, so the interest rate mentioned in the bond is 10%. So here this is the yield. This 1,000 rupees is the yield, how much you got for your bond. So you got how much? 10% of the, so your yield is similar to the interest rate. Your yield is similar to the interest rate. Now what happened? The person who purchased this bond, after a year, he want money. Now it's only a bond. It is not in liquid form. He have to liquefy it. He want cash. So he decides that he want urgently money. So what he will do is, either he will go to the secondary market and sell it off. You getting the point? He will sell this government security. He goes to the secondary market and sell it off. Now when he goes to the secondary market, things is different over there. In secondary market, because of demand and supply, sometimes the bond price will be high or bond price will be low. So that we can't judge. Now if suppose when he goes there, the bond price of which is 10,000, the bond price of 10,000, now he is selling it off. Now I am just telling the what is this yield is all about. Don't leave that secondary market. He want emergency money. He thought, okay, I have already got 1,000 rupees. I am ready to sell this for 9,000 also. I am ready to sell because he want quick money. So he is selling this bond which he purchased for 10,000. He got after a year 1,000. He is thinking that, okay, let me, I want money urgently. I am going to sell it off. So he is selling it, this bond, for how much rupees? If he suppose he is selling this bond which is having a face value, the face value of that bond is still 10,000, but he is selling it for 9,000, and the interest mentioned in that bond is still 10%. So the person who purchased this bond for 9,000, after a year, how much interest he will get? He will get 1,000. You getting the point? The person who purchased the bond, he will be getting 1,000 rupees. Now you just calculate his yield. His yield is, he is getting 1,000 rupees. He is getting 1,000 rupees for what? For how much he invested? He invested only 9,000. For the person who purchased the bond, he is getting 1,000 rupees, but how much he has paid? 9,000. What is his rate of return? His rate of return is more than 10. Exactly, if you calculate, if you 1,000 by 9,000 into 100, you will get 11. His return is 11.1%. His return is, the person who purchased his return, because he purchased the bond for 9,000. So even though the interest mentioned in the bond is 10%, actually he is getting more than that. Why? He purchased the bond at a lesser price. Bond price have fall. How bond price have fall? The bond price was 10,000. From 10,000, if he is selling at 9,000, means the price of the bond have fall. But what happened to the yield? The yield have increased. So yield is the return the investor get for purchasing a bond. Now this is direct explanation, but in secondary market it is not like this. It's in crores, and the trading is happening in seconds. So how that trading happen on all these things is not at all important for you. I already told you, it's simple. You need to know one relation. What is that? What is the relation between bond price and bond yield? What will happen? It's having an inverse relation. When the bond price will increase, bond yield will comes down. When bond price will increase, similarly, when the bond price fall, the yield will increase. When the bond price, see here in this case, bond price have fallen, yield have increased. This is only sufficient. I am telling you. Now what you need to do is, now almost every 2 days or almost every day, an article will come on the bond. It will be a small article. I will take a photo and WhatsApp you. Just read it and understand it. What is that all about? Now there, when you read it, the movement will not be like this. It will be mentioning in 100. 106, 107, 108, because that is in relation to a base. The base they have taken, instead of 10,000, it has taken a base as 100. Now here now what happened here now? When the bond price fall and rise happens in relation to buyer, yesterday's buyer and today's buyer. You are getting the point? See, when the government issued it, suppose he has issued for one bond for 100. So it will be lakhs of bonds will be there. Now after certain period of time, that same bond which is having an interest rate of 6.7 have been purchased at, see, yesterday a person have purchased for this rate. Today see, why these people are purchasing? They are purchasing that bond for profit. They are speculators. They are speculators, like stock market speculators. In government security market also, for profit they will purchase and sell. They will purchase for a particular price and they see the yield and then sell it off. When the bond prices, if they purchase at a lower bond price, when the bond price have increased, they will sell and they will book a profit. So that's a different thing which we will be discussing in capital market, which I told you. We will discuss how the stock market functions in capital market. For you now is what is important is to understand the relation between bond price and bond yield. Is it clear with this bond? So don't go to the second part which I discussed, that that's little bit complicated, because you are supposed to believe yourself that you have started economy today only. So in that case, leave that second part. For you, is this concept is clear? That yield movement, what is yield? Yield means the return for your means the income return. So is it higher or lower? Is it higher or lower? Obviously, if the bond prices have fallen, then your return or yield will be high. If anybody is having doubt, you just write down this so that you will have a clarity regarding this yield movement. Okay. Now this thing will be coming again and again and again in the newspaper. You read it and be clarified, and they will not, I am telling you, they will say like something like this. Now we have to link it to the interest rate regime. That we will do it later on. Now you understand this relation, the relation between bond price and bond yield, and how it will be related to the interest rate, general interest rate, and what I discuss in relation to US, we will deal it separately, because again these things will come again in other topics. Okay, so just be clear with this bond price and bond yield. Still doubt is there in relation to bond price and bond yield?